October 28th, 2008. Markets worldwide are collapsing. Yet Volkswagen's stock surges 400% in hours, briefly becoming the most valuable company on earth. Short sellers lose $30 billion in 2 days. Behind this, not a bank, not a government, a small sports car maker called Porsche, executing a secret playbook that triggered the greatest short squeeze ever. It started with a trade everyone thought was safe. To the world's most sophisticated hedge funds, shorting Volkswagen was a calculated decision, a mathematical certainty. By 2008, the German automotive giant looked like a lumbering relic of the old industrial world, highly inefficient, weighed down by state protection, and trading at a price that defied economic reality. For years, institutional managers watched Volkswagen's stock climb, convinced the valuation was an unsustainable bubble. The global economy was slipping into a historic recession, consumer spending was drying up, and car manufacturers worldwide prepared for a brutal downturn. In this environment, betting against an overvalued automaker seemed like the safest, most disciplined trade on Wall Street. This conviction quickly hardened into a crowded consensus. From London to New York, major investment banks and elite fund managers built massive short positions, borrowing and selling Volkswagen shares with the expectation of buying them back later at a fraction of the cost. These managers acted on hard data, building a textbook strategy backed by rigorous spreadsheets. The German state's legislative protections made a hostile takeover seem virtually impossible, ruling out any sudden, irrational spike in the stock price. On paper, the trade was completely bulletproof. Every metric pointed to a structural decline, and the smart money was in absolute agreement. At the heart of the short seller's confidence was a specific piece of state legislation, the Volkswagen Law. Passed in 1960, this statutory shield dictated that any major corporate decision required a supermajority of over 80% of the voting shares. Because the German state of Lower Saxony held a permanent 20% blocking minority, no outside entity could ever force a hostile takeover. For an activist investor or a rival car manufacturer attempting to acquire Volkswagen was a legal dead end. The state of Lower Saxony held the ultimate veto power, and its government had zero interest in selling its crown jewel to corporate raiders. Hedge funds looked at this structure and saw an absolute ceiling on Volkswagen's stock price. In a typical short trade, the nightmare scenario is a sudden buyout offer that sends the stock skyrocketing. But here, the German government stood as a permanent roadblock. The law guaranteed that the tradable supply of shares could never be locked up in a secret acquisition. Wall Street managers calculated their risks with absolute mathematical certainty, believing the Volkswagen Law made a sudden price spike impossible. They saw a protective shield built of state law and political interest. What they failed to realise was that this very shield had created a blind spot. Porsche's leadership had no intention of playing by Wall Street's established rules. CEO Wendelin Wiedeking and CFO Holger Harter were quietly designing a quiet, multi-layered counter-strategy. They recognised that a direct hostile takeover was impossible under the Volkswagen Law. Instead, they chose to play an entirely different game of financial chess. Harter's masterstroke was a derivative strategy that bypassed traditional regulatory radar. Porsche began buying Volkswagen shares directly, eventually amassing a 42.6% equity stake. But buying more on the open market would drive the price up and tip off the entire financial system. To build the rest of their position in secret, Wiedeking and Harter turned to cash-settled options, acquiring contracts covering an additional 31.5% of Volkswagen's ordinary shares. Think of it like trying to buy a rare house. If you try to buy it outright, the neighbourhood notices and the price skyrockets. Instead, you buy a secret deposit ticket. This ticket doesn't give you the deed or the keys immediately, but it guarantees that you control the transaction when the time comes, all while keeping your name off the public registry. Because these options were cash settled, they did not carry immediate voting rights. Under the German Securities Trading Act, this structural loophole meant Porsche did not trigger the 5% disclosure threshold for derivative positions. While the market saw a modest shareholder, Porsche had quietly locked up a massive 74.1% economic exposure to Volkswagen. The trap was set, and the short sellers had no idea the house they were betting against was already spoken for. On Sunday evening, October the 26th, 2008, Porsche published a brief press release on its website that shattered the peace of the weekend. The announcement was dry, but the numbers inside it rewrote the laws of physics for the Frankfurt Stock Exchange. Porsche disclosed that it held 42.6% of Volkswagen's ordinary shares outright, alongside cash-settled options covering an additional 31.5%. Together, this handed them 74.1% economic control. The math that followed was brutal. Take the entire universe of Volkswagen ordinary shares, 100%, subtract Porsche's 74.1% stake. That leaves 25.9%. But the German state of Lower Saxony held a permanent 20% blocking minority that was never going to sell. Subtract that, and the remaining free float, the actual supply of tradable shares on the open market, shrank to just 5.9%. Yet the aggregate short interest held by hedge funds stood at 13%. The short sellers collectively needed to buy back more than double the entire available supply of shares just to close their positions. There was no way out. No alternative supply, no escape route, and absolutely nowhere left to buy. On Monday morning, the trap snapped shut. When the trading screens lit up, the Frankfurt order book became a vacuum. A massive wave of automated buy orders hit the floor as risk engines at the world's largest prime brokers began screaming. Risk limits breached, triggering mandatory liquidations. Every short seller needed to buy the exact same stock, but there was nobody on the other side willing to sell. Price discovery completely disintegrated. Offers to sell vanished entirely, leaving only desperate, skyrocketing bids chasing a phantom supply of shares. This was a raw liquidity crisis, completely detached from corporate valuation. Lenders demanded their borrowed shares back immediately, but there were no actual shares to be found in the system. The scarcity was absolute. To survive, hedge funds had to hit whatever ask price appeared on their screens, no matter how irrational. They were forced to buy at any price, and the panic was just beginning. This was no longer a human battle. The market's automated architecture had taken over. When the stock price breached €500, the squeeze became a self-fueling loop. Investment banks that had sold Porsche those cash-settled options were legally bound to hedge their exposure. To do so, their risk algorithms automatically bought Volkswagen shares on the open market. But every purchase drove the price higher, which increased the options delta, forcing the algorithms to buy even more. It was a closed loop of cold math. Margin calculators at prime brokerage desks automatically triggered liquidations, selling off other assets to buy Volkswagen shares at any price. Human traders became spectators to their own ruin, watching helplessly as the system executed their destruction at the speed of light. The Frankfurt order book was a black hole, feeding on itself, and there was no override switch. The board has cleared, but the game never ends. Today, Wall Street still hunts for sure bets, forgetting that silence is often the ultimate trap. In global finance, the most dangerous opponent is always the one you never saw coming. What is your move? Let us know below.